Hi Flagstone community, this is Lead Wealth Advisor Dan Staus with another brief market update for you. You may have noticed in the news that the stock market has reached several all-time highs this year, continuing the market rally from last year. So I wanted to take a couple of minutes to explain what's driving those returns and what does it mean for the everyday investor. First, the fact that the market has fully recovered from 2022 bear market is positive news. Markets have already hit several new record highs this year. But with that being said, we understand that some investors may feel a little antsy when the market is at record levels, and underlying those concerns is a feeling that maybe markets will reverse course. However, this chart paints a little different story. So the bars that you're looking at represent how many times during a calendar year that the market has reached a new high, while the line shows how the market has increased in value over time. And since markets tend to trend upward over long periods of time, it's also the case that bull markets tend to experience new all-time highs. So you can see that from 2013 to 2021, for example, markets made dozens and dozens of new records each year. And that should be expected, right? If something tends to go up more often than it goes down, you'd expect to see it consistently setting new records. So the point is that new all-time highs are not in and of themselves reasons to be worried about markets, and instead we should focus on the business cycle and the underlying fundamentals. So that's exactly what this chart shows. The first set of bars shows the previous 6 quarters of GDP results, which is a measure of economic growth in the US. The latest GDP figures for Q4 of 2023 were far better than many economists expected, with growth of 3.3%. Now you can actually see on the left that GDP growth has been pretty steady since the second half of 2022. The second set of bars is the personal consumptions expenditures, which is the largest component of GDP. It's basically a measure of consumer spending, and that's been particularly strong. The third set of bars, business investment, labeled here as gross private domestic investment, has also contributed positively to growth. So the story that this chart tells is that growth has been pretty strong, and that's an important reason markets continue to trend upward. Let's take a look at one final chart. For investors who are worried about market levels and would prefer to wait for a pullback, history shows this can often backfire. This chart shows how long an investor would need to wait for a particular size pullback and what the opportunity cost would be. For instance, take a look at that fourth set of bars, the second from the right. Waiting for a 4% pullback would require waiting 153 trading days, and historically markets would have gained more than that 4%, 6.4% in this example. So it would have been better to have been invested that whole time. If you look at the last set of bars on the far right, waiting for a 5% pullback typically takes 291 days, and the average returns during that time period have been 13.1%. Now, of course, this doesn't mean that markets are going to move up in a straight line every day. We know that as investors, there's big ups and there's big downs from day to day, and really nothing's guaranteed. But the overall message here is that the market recovery is positive news for investors, even if there's some uncertainty about what's going to happen next. Now, we hope you found these insights to be valuable. If you want to discuss any of these topics in more detail, please reach out to us. We'd be happy to chat with you. If you're a Flagstone client, thank you so much for your relationship. And to all of you, thanks for watching.